I will be calling on the next panel, which is harnessing the potential of SMEs. I will call on the moderator, Winnie Mwangi, who is the managing director of Finca Ventures. She will come up and introduce her panelists. Winnie is the managing director of Finca Ventures. She is a venture capital investment professional with 18 years experience in commercial venture capital, impact investing, and M&A in sub-Saharan Africa. Winnie, the floor is yours.
Thank you. You know, across Africa, we talk about potential. Africa's potential, the youth's potential, and the continent's potential. But today, I want us to talk about harnessing that potential, not as a dream, but as a strategy. Because here's the thing, Africa's growth story will not be written by multinationals. It will be written by small and medium enterprises. These create 80% of jobs, innovate with limited resources, and turn constraints into creativity. African SMEs are the heartbeat of the economies. But too often, they're running uphill with weights on their ankles, limited funding, fragmented markets, and fragile supply chains. But despite all this, they endure, they build, and they adapt. Our panel today is comprised of individuals who are not theorizing about this. They are deep in the trenches, investing, shaping, and building the ecosystem that's fueling Africa's backbone. Today, we'll explore two key themes. The first one is on enabling entrepreneurs and the key drivers for growth and innovation. The second theme is on building resilience, how we strengthen these businesses to ensure long-term sustainability. Expect honesty, a challenge, and practical insights. I'd like to welcome the panelists on stage. If you can please join me. I'm your moderator for the day. My name is Winnie Mwangi, Managing Director at Finca Ventures. We invest in the resilience economy, focused on early stage businesses in sub-Saharan Africa. Please join me in welcoming the panelists on stage. Could you please start introducing yourselves, maybe Brenda?
Good afternoon, everyone. Sorry, I have to check because of the time differences. Brenda Monye is my name. I work with FSD Uganda at the Deal Flow facility as their portfolio relationship manager. I'm happy to be here.
Good afternoon, everyone. My name is Anne Juki, and I'm the founder and managing partner of Sayuni Capital. Sayuni is a private credit fund that lends to profitable SMEs in East Africa that operate across the consumer value chain. So we invest in agriculture, manufacturing, logistics, and trade. It's lovely to be here.
Good afternoon, everyone. My name is Thomas Pascoe. I'm the team leader of Manufacturing Africa. Manufacturing Africa is an FCDO-funded project that works across 6 different markets in sub-Saharan Africa. And we aim to facilitate FDI into manufacturing businesses on the continent. So far, we've been going for 5 years. We've supported something like 260 different companies. About a third of those reach financial close in the end, and investment. So that's about £2 billion worth of investment that we've facilitated, and around 110,000 jobs created. So delighted to be here. Thanks.
Hello, everyone. I am Christian Amour. I am Investment Director Africa for Rain Capital. Rain Capital is a French-European impact investment venture capital. We invest mostly in Europe until last year, where we raise we create an African fund called Africa Venture Africa Impact Fund 1, and I'm the one implementing that fund. So We are in a VC ecosystem, meaning that we don't work alone. We are building an ecosystem that help us building the value or creating the value that we want to provide. Happy to discuss with you today.
Hi everyone, super happy to be here. I am David Munich from INP, Investor and Partner. We are a group of funds and investment professionals dedicated to supporting African entrepreneurs and African SMEs. And we've been active for a bit more than 23 years now, supported more than 300 companies, mostly in equity and quasi equity on the continent only. Thank you.
Thank you to all panelists. So we'll start with our first segment, which is empowering small businesses. Let's start from here, because we love to romanticize entrepreneurship in Africa. We encourage our youth to start businesses, but yet we rarely talk about how these businesses are supposed to grow in an ecosystem that's not built for them. On average, SMEs in Africa operate in environments that test their courage constantly, almost daily. Infrastructure gaps, limited funding, inconsistent policies, and quite frankly, pure survival economics. So my question to the panelists today is, what are the critical enablers to ensure SMEs move from survival to sustainable growth?
I go first?
Sure.
Yeah, so just also to mention that at the deal flow facility, we do support growth stage companies in Uganda to access private capital. So we support them with investment readiness, support them with investor matching, and also handhold them to deal closure. Get your question again?
Yeah, so what are the critical enablers that, that enable SMEs to move from survival to sustainable growth?
So as an ecosystem player, what we've seen that would really move most of these SMEs to grow to the levels where they, to their full potential is a lot of collaboration. So this collaboration really would be with different players in the market. For example, if you look across the panel, we have investors, we have enablers, we have, we need to have government stepping in. So from where I sit, a lot of collaboration needs to happen. And this collaboration needs to happen in a very targeted way. It has to happen, for example, in sector-specific programs that support, for example, we have programs that focus on agri, programs that focus, for example, on digital businesses in the digital world or in the financial space. So collaboration between government and private players is very critical in developing and supporting some of these businesses. I will also like to mention that the donors play a very big role. For example, the Deal Flow Facility is an EU-funded program, and we've been able to support 60-plus businesses with investor readiness, and we've been able to close 6 deals in the last 3-4 years, but that would not be possible without donor support and collaboration with the private sector. So if you ask me, I think a lot of collaboration with the different players in the ecosystem is important for us to get these businesses from the startup level for them to be able to get to their full potential.
So the typical profile of the SMEs that Sayuni Capital invests in are: 1, they're owner managed, 2, they usually have revenues of $1 to $5 million, and 3, they lack a lot of the processes, the systems, and the governance in place to be able to take on institutional capital. And so then what's important is that typically in our first conversation with the entrepreneur, we ask them, what do you need to grow? And they almost always say, just give me money, and we'll be fine. And we find that money is typically not enough. In fact, if you put in money in some of these businesses without fixing some of the fundamentals and the foundational issues first, you're throwing good money after bad. And so what we find is important is, 1, do you have an entrepreneur that's willing to take the leap and make the jump to be a more professional SME? And that typically involves putting in very, very basic systems and processes. From a governance perspective, for example, we're not even asking them to put together a board. We're just saying, look, you need to document how you make your decisions. You need to document how you move money from one bank account to another. So that's one. The second thing that we also put in place is really the a basic financial system in place. So a lot of these companies can tell you, I have $500,000 in cash in the bank, but they have no idea how much cash profit they're generating. And so just putting in place the basic, again, very foundational financial structures in place. And then third is really around culture and people. And this is important so that even when you have a small SME that's making even $1 million or so in revenue, do they have the right people? Are they thinking about how they hire and train and to some extent even develop their people? Because they're so small, they typically keep employees on for a long time and they don't have a lot of churn. So we find those to be the three foundational elements that we believe can grow an SME from I think what Brenda described as a startup and early stage to really mature and professionalize them.
Great, thanks. I think from my perspective, which is FDI and really mid-sized companies that we're looking to support, to go from big to small, it's kind of country, market, company. So at a country level, a lot of those things are going to be out of your hands. But particularly with manufacturing businesses, FX, when you're selling in local currency often, you're buying abroad in dollars, very, very important. The tax regime, particularly as you've got fixed plant and machinery, and you can be a bit of a cash cow for local governments, you need real kind of visibility on that. At a market level, when you're looking for FDI, what is the maturity of the ancillary services that you can buy in around transactions? Do you have access to proper corporate finance support in that market, for instance? What's your discoverability when it comes to international investors? How much of an actual market is there that can be made there and that can enable you getting that investment? And then at a company level, look, it's a lot of those basics of kind of good housekeeping, good financials, good governance, particularly in environments where you're looking to borrow as a business at kind of domestic rates of 20% or more. That's a really high hurdle rate that you have to clear when you're showing what you can do with that capital and the profit that you're able to generate out of it. So really well-run businesses, great teams, and clear books, I think are very important there.
Yeah, I will answer to that question based on what we're currently doing now, but also based on my past experience. Before joining Ring Capital, I was working for the MasterCard Foundation Africa Growth Funds as value creation coordinator. So I was actually in charge of providing that support to SMEs and companies we were funding. And one of the things we discovered, we were supporting before I left, we were supporting at least 40 companies, something like that. And we discovered that most of them, I think we discovered three main issues that they were facing that were maybe restraining them to scale. One was financial and data. I would call it data, not just financial, but data management, having data in the company to be able to build to improve their operation. That was the first thing. How do they manage the data in the company? Secondly, operation. A lot of them wanted to expand or to grow fast, but if the operation is not well run, well built, it was very difficult for them. So we were supporting them, building their operation, a strong operation. And the last one was the strategy, on having the right outside data, because you have the inside data of the company, but you also need to have the outside data. So I think those are the three main things that we discovered that was coming from most of the company that was wanted to grow fast or to expand. And then after you have that, I think you also need the most important, which is the fund, money. So that's how we were working with them. So data, operation, and strategy.
Thank you for the question, and of course I'm going to elaborate a lot on what was just said, especially by Brenda and Anne. From my experience working with entrepreneurs, what it takes to move from the talented but starving artist to a profitable business is, I would put it in this way, two things. The first one is the team, because very often when we meet up with a very talented entrepreneur, that's a one-man show. It's a one-woman show. It's a single person, very talented, with a strong vision, but just an initial activity, product, customers, but very often the team is lacking, and so it's a question of talent and gathering enough talents and skills around the entrepreneur, and then building a middle management to help the team and the business grow in terms of finance, in terms of sales, in terms of marketing, in terms of production, etc. So the team would be one. And of course, I agree with what you said. I think the second key topic is governance. It's how to make a relevant financial forecast, how to recover the money from your customers. And I think governance can help play a key role on that, and we are going to speak about it probably later. It's what probably the investor can bring.
Yeah, thanks. And finance has obviously featured in your feedback. So my question to you, Brenda, is what is the role of blended finance, and how can blended finance unlock growth to help SMEs really move to sustainable growth?
Yeah, thank you so much, Winnie. I think the key theme that has cut across the responses that my panelists have shared earlier is that most of these SMEs have a lot of potential. And if you've interacted or done work within the continent, the African continent, you realize that most of these businesses have a lot of potential. However, they lack various things. They lack structure, they lack governance, so they are not attractive to different financiers, right? There are so many issues around them accessing capital, high interest rates. Some of them are operating in what they call risky businesses. I don't know if there are bankers here, but I'm yet to see a banker that will directly lend to a farmer because of the risks around, and yet we all know that agriculture is the backbone of most African countries. So there are so many issues around, there's country risk. So most of these businesses are not able to access credit for various reasons. They don't have collateral, and this is where blended finance comes in. So blended finance is really capital that is put into what you'd call the risky business, and it takes different forms really. There's the first loss guarantee, and also for most financiers, they would be more attracted to a business that has traction, to see that this business has handled money before. There's been investment in that business before, they've borrowed before. However, because of the challenges that I mentioned earlier, most of the SMEs are not able to access funding because no one knows what their track record is. But if you're able to guarantee, and this is where I mentioned earlier, government and donors and different players coming in to collaborate to kind of give them some kind of initial financing. It could take different forms, like I mentioned, the guarantees. We could also have, for example, a TA grant facility that enables them to fix some of their structural issues that may deem them to be less attractive, and then at the end they get some kind of funding. It could also be what would they call it? RBF, the R word. Revenue-based financing. So these types of financing they change the mindsets of the different entrepreneurs. Like I mentioned earlier in the earlier session, for those who were there, most of the businesses that we deal with are interacting with fundraising for the first time. So they have no idea what investor expectations are. But with these kinds of technical assistance, whether it's grant related, whether it's concessional financing, whether it's, all those different types of blended finance, the tools that we use kind of give them that initial start for them to start realizing their potential. And this can only be done, like I mentioned, with collaboration, and I think I've said it 10 times since I got here, because it's a real problem that we see in the market, at least where I come from. You have different players in the market and everyone is doing something different but kind of with the same agenda. So how about we collaborate? How about donors and DFIs and the government and different funds, come together to come up or create certain financial tools that would be able to offer some kind of concessional financing to these businesses. Because I think once a business starts borrowing and they see the value in it, they pay back, they will continue to do so, and they will definitely grow. Their dreams will, we have businesses that we've interacted with that didn't know that they had the potential, for example, to increasing their capacity, because they were not aware that they had they could actually access private capital. So if you ask me, I think blended finance is very important. It's one of the key tools to enable us finance SMEs in Africa. However, it has its challenges. For example, if you're offering guarantees, we don't have so many of those in the market because of the risks. We also have skills issue. We have capacity issues around offering some of these solutions. But I believe with the right collaboration and the right skill sets, we should be able to offer some of these blended finance tools to these SMEs to enable them to realize their full potential.
Thanks, Brendan. I agree with you on that collaboration. It takes an ecosystem collaboration for this to actually work in our markets. So in the universe of founders within Africa, I'll zero in on two particular founders, women-led SMEs and local-led SMEs. So my question to you, Anne, because at Sayuni Capital you focus on those two groups of founders, what are the structural barriers and challenges faced by these two types of founders? And what has Sayuni Capital done in terms of designing capital solutions to level the playing field for them?
Thank you, Winnie. So yes, Sayuni invests in two types of entrepreneurs. So one, SMEs that are owned by either women, or two SMEs owned by local entrepreneurs. These are typically companies in what we call the missing middle. So they are usually too large for microfinance. They've outgrown friends and family money, but then they're too small for institutional capital, large banks and large private credit funds. And so they struggle to borrow from banks, and they're typically not able to access equity financing as well. And so there are two barriers that typically prevent these types of companies from borrowing. Very briefly, one is a lack of collateral or security. And so typically banks will require 150% of the value of the loan as collateral. So for every dollar that you borrow, you need to have 1.5x in collateral. And at Sayuni Capital, we do a couple of things to help lower this barrier. So one is that where we require land for borrowing, we'll typically take collateral that as low as 75 or 80% of the value of the loan, and we'll take third-party collateral. And the reason is a lot of times these entrepreneurs have chosen, very wisely I should add, to really reinvest in their businesses, and so they don't often have land. And so we'll say, look, we'll take third-party collateral instead. We see this as a large issue, particularly for women, because a lot of women still don't have agency over land. Another solution that we see is that we are also putting in place receivables financing, particularly for trading companies, so we can take receivables as collateral in place of land. A second barrier that these SMEs face, and I'd alluded to that earlier, is that they often don't have the right processes, systems, they don't have credit history as well to be able to borrow from large institutions. And what does that mean? So we're able to build a strong credit history of the company using a proprietary approach. So we look at your mobile money statements, we look at your bank transactions, we look at your individual CRB, Credit Reference Bureau history, to then build a very strong credit score for you as a company. And so that way you don't have to come in with audited statements, which we find are often either incorrect or wrong. You don't need to have a pitch deck, but then we can build a very strong financial picture for whether or not you're able to pay us back as a company.
Thank you, Anne. And let's stick to the theme, the thread of underrepresentation. Again, if you look at the venture capital landscape in Africa, even with the kind of evolution we've had over the last couple of years, majority of the capital still goes to specific markets. But at Ring Capital, and the question to you, Christian, you focus on underserved markets in Africa. What investment strategies or ecosystem partnerships have you found effective that will catalyze innovations and also scaling for high impact startups in underserved markets?
Okay, thank you for the question. I think we approach that situation on two ways. First, It's to acknowledge the fact that if the market is underserved, it probably also means that the ecosystem is young, it's in burgeoning. So that's the first thing we acknowledge. The second thing is also that if the market is underserved and the other market is overserved, it means that we have probably more mature companies in the overserved market. So how did we approach it? We decided to invest or to build our investment thesis on the 3 stages: seed, pre-seed, Series A, and pre-seed, seed, and Series A. And we have a different approach of investment depending on where we invest. On the pre-seed stage, we decided to work with a venture studio, which is based in Ivory Coast, because we consider that the pre-seed is very risky. Entrepreneurs need a lot of support in that stage. They need like overall support. So what we do on the pre-seed with the studio, because the studio is already based, understand the market, understand the concept, the context. We originate idea with them. They build the company with the founder on the studio. They provide the support. It can be financial, technologies, expansion, all those elements, and we fund the company in co-investment with the studio. That's how we invest in the pre-seed. On the seed approach, we are building our experience in Europe, because in Europe we already have growth funds, we have a seed fund, and we have a pre-seed fund. So in Europe, we are building our experience in Europe in the sense that because we have companies that are already mature in Europe and we have experience in the sector on which we are investing in Europe, it can help us anticipate and understand better some model that has been successful in Europe and understand them better in Africa. That's why we are calling ourselves our ecosystem, because we work all together. People that work in Europe work together with people that work in Africa. So that's also an approach. And one of the key things we also do is that on the pre-seed level, most of the ideas that are originated are ideas generally that has been successful in English-speaking countries. So it makes them easier for the English-speaking companies to acquire them if they want to expand, or also for us to understand the lesson from other parts. Yeah.
Thank you. And being mindful of time, I've had the bell ring. First thing, just the last 2 questions again to you, David, very quickly. Why is local fund management empowerment important for SME growth in Africa?
Thank you, Winnie. I think there are 3 reasons: the proximity, the cost, and the resilience. Supporting a business or an entrepreneur is about proximity. It's about understanding the needs. It's about being able to find a solution. It's about being 15 minutes away from the company and being able to avoid the risk, to avoid mistakes, and to be there when the business needs it. Then it's about cost, because if you want to make it feasible, profitable, or worth investing, you need to manage the cost. And hence, it's useful to be very close, as close as you can, to the business. And then about resilience. It's about having the possibility for the capital, for the investors, to not fly away as soon as there is a problem, and to really stick to the mandate and the mission to support entrepreneurs. What we have done is that we have created African investment teams and African funds that are locally based, as close as possible to the SMEs, with the majority of African capital raised from banks, insurance companies, mobile operators, individuals. And these funds and teams deploy capital for small ticket sizes into startups and SMEs. It's the case in Côte d'Ivoire, in Senegal, in Uganda, in Burkina Faso, in Madagascar, and elsewhere. And we support these funds and this network of funds and investors in order for them to really promote African entrepreneurs.
Thank you. And Thomas, you focus on mid-sized companies at Manufacturing Africa. And these companies are constantly raising capital from international markets. What are some of the challenges that these SMEs have faced? What are the obstacles of raising capital from these markets?
Yeah, so to think about the obstacles, I think it's probably useful to think about the things that are completely out of your control as a company or investor, things that are difficult but within your control, and the things that are easy and completely within your control. So look, the biggest hurdles for investors are kind of principally the macro. I think that's overwhelmingly the case in some markets where you have currency devaluations, you have a lot of uncertainty over tax policy, you have the risk of political violence, and kind of all of that sums up to an Africa premium, which I'm aware often feels unfair, often feels arbitrary, but it is there, and so those investors need to be assured that they will get their money back when lending at that premium or investing at that premium, and that can often have quite a high bar. I think the things that are kind of challenging but within your control are all areas where Manufacturing Africa tries to help the companies that it serves. So what we often hear from investors talking about the companies that we work with is one, they don't, it's an information poor environment. They don't have a sense of the scale of the market opportunity beyond really broad brushstrokes. So we can often help with kind of market opportunity deep dives that really try to add sort of a bit of tangibility to what's the scale of the opportunity. There's corporate finance and kind of getting the books in order, straightening out related party transactions, getting these presentable for an external audience. It's quite important. ESG, GESI, climate, the narrative around those, the policy set around those, and the emphasis will change from industry to industry. But for instance, within agri-processing, where you're working with a huge number of sort of smallholders who are inputting into, say, sort of an aggregator that then goes to processing, in a kind of female-dominated supply chain, how are you keeping those people safe? And what are you doing at a policy level? An investor will be interested in that. A domestic business sometimes won't have thought about it because they're so busy growing the business. So that's important too. And then manufacturing operations. So look, have you actually optimized what you've got already before looking at kind of expanding plant and machinery? So you might be able to achieve a 30-40% increase in your output by moderating the environment in which you're producing your goods, changing around the order in which things are done and optimizing sort of space, etc. So all of those areas we help businesses, and we find that takes them close to transaction. The one thing that's completely within your control as a business looking for FDI that a surprising number of people get wrong is just responsiveness. I'm very blessed in this job that I travel all over Africa, and often the visa requirements sort of make you raise an eyebrow, and so be busy getting my father's birth certificate from somewhere or other and sort of providing that for a visa. But I'm going there. And so you need to honour the sort of the set of rules around kind of how that's done. I think quite often we hear from investors that they just can't communicate with businesses over email reliably. Decisions grind to a halt because the executive team are afraid to make a decision when the founder is away and the founder won't answer a call on holiday. Really sort of basic things like that. Again, it's not important necessarily how those things are done in the domestic market. What's important if you're looking for foreign capital is that your business practices and responsiveness actually mirror those of the markets where you're looking to raise from. And that's, I think, an easy win that a lot of our companies have to get to.
Thank you, Thomas. And now we'll move on to our second theme, which is building resilience. Brenda, my question to you is, what are some of the structural challenges that present obstacles for SMEs to build resilience within Africa?
Yeah, thanks for that, Winnie. I was actually laughing when Thomas was speaking about the unresponsiveness of businesses, which is a challenge. And he said something around businesses that are trying to mirror the behavior on the other side, which is going to be a real challenge. Because some of the businesses that we work with, most of these guys are not. I think it's also important, I'll get to the question, but also I think it's important for investors or financiers to also adjust to the market in which they want to invest, because the money is not free. You're going to get a return in the end, so you kind of need to balance it out. Understanding the market, or understanding that some of these entrepreneurs are not educated, which is most entrepreneurs in Africa. They are not educated, they are not technologically savvy, will help you understand the reason why there are some of those delays. And why I say that is from first-hand experience. We have businesses that are turning over probably $2 million in revenue a year, and the promoter or the entrepreneur does not know how to use the laptop. So as an investor, if you're sending him an email, he has to wait 2 days to meet his son or the neighbor or someone who can actually respond to the email. So it's also important, yes, you have a point, but it's also important for the financiers to understand the markets in which they are going to invest. Otherwise, you end up trying to compare apples and carrots, and that marriage will not definitely work. So back to your question, we do have, of course, businesses have lots of structural challenges, and I'll not belabor the point because we've really spoken severally across the panel. Issues around governance, most of them don't understand why they need a board, and these are things that are characteristic to family-owned businesses. Most of the businesses in Africa are family-owned. So all the challenges that come with key man risk, like he mentioned, they are waiting for the CEO who is the founder to make a decision maybe 2 weeks or 3 weeks later, and he's on holiday or he's attending a family something. So it's issues around governance, and governance from managerial level, issues around their financial management, which we've spoken about. Most of these businesses have 3 books of accounts. They will present, depending on who is asking, is it the taxman, is it the investor, or is it the actual book of accounts? So there's issues around governance beyond just having, a managerial system, but issues around the financials, issues around their business models, issues around honesty, issues around, of course, responsiveness, like he mentioned. Most of them are not able, they don't realize or appreciate the fact that they need to move beyond the startup phase and hire skilled labor, for example. So you find that most of these businesses don't understand why they need to hire a skilled accountant when his brother's son can quickly do the books. But is he skilled? No, he's not. So governance is a real challenge, and it cuts across so many parts of their operations, and that is a real hindrance. But hope is not lost, because there's a lot that can be done, from, like I said, from the private side, from the government side, also from the investor side. There's a lot of support that can be given, but that support can only be given once you appreciate the type of entrepreneurs that we have on the African market. And they are different. I keep saying, just the Kenyan businesses and the Ugandan businesses, we are all in the East African region, but our economies are different. Our levels of exposure are different. So most of the investors are regionally sitting in Nairobi. So if you come to Uganda to do a due diligence with the same standard that you would do a Kenyan business or a Tanzanian business, chances are that you won't get the same results. Yeah. But are the 2 businesses, do they have high potential? Definitely, yes. So there's a lot that needs to be done, of course, in terms of investment readiness. Investment readiness is key to us basically trying to, to fix some of those gaps or some of those governance issues that we see with the businesses.
Yeah, and I agree with you, and that's, I think, one key message we need to keep drumming in. It's not just product market fit, it's also cultural fit. Cultural fit is extremely important. So David, I'll bring you in. And it seems like a lot of support is needed at this very early stage. What's the role of local fund managers beyond capital in supporting businesses to really strengthen their governance and build resilience?
So someone was saying earlier that entrepreneurs ask for money, and actually money is not enough. So I think that there's a link with this. Of course, bringing capital is key, because without capital, hard to invest, hard to grow. So, of course, this is very, very central. At the same time, what we see is that, and as we said, governance is also very highly needed. And the 2 have to go together. And I think what makes the investment relevant is the link between the capital and the support to the entrepreneurs, to making the right decision. Being an entrepreneur can sometimes, it means also being lonely. It means that the entrepreneur is very lonely in front of decisions, of arbitrage with family members in the business. So it's not easy. And I think governance is the way the support can be brought to the entrepreneur by challenging the financial forecast, challenging decisions, sharing the decisions, of course, with board members, for instance. So I think beyond capital, and of course we were mentioning skills and teams, I think governance is really a key success factor to help avoid mistakes, avoid failures, weather the storm in crisis, and to try to find resilience. And from this standpoint, it makes sense to have local shareholders in the business.
Yeah, thanks. And again, I think women build differently. Women do things differently. And I think it's time to learn how women do things differently. Sayuni Capital, again, you'll come in and on this, just to talk about your experience on your view on how women build differently and are able to sustain resilience for much longer. How do we do things differently?
I'll answer very, very briefly in the interest of time. I keep hearing the bell. So just in a minute, so Sayuni Capital, we invest in profitable SMEs owned by either women or local entrepreneurs. So 2/3 of our portfolio is either majority or fully women-owned companies. 3 quick things. One is women are very, very hesitant to take on external borrowing. 2, they are very, very good about paying back. But then 3, they are very conservative in terms of how they grow their businesses. And so based on our limited experience and what we know, we try and structure our products and our support to the companies with those 3 things in mind.
Thank you. 2 more feedback from the panelists. Let's keep it brief as well. Again, Christian, in the underserved markets you serve, how does a VC fund like yours balance financial performance and developmental impact in an uncertain environment, obviously marred with political risks, economic shocks, currency fluctuations, while at the same time still supporting entrepreneurs who are innovative and are resilient?
Okay, that's a good question. I think at Green Capital, and what we have discovered is that we took a different approach, because most of the time people assume or take impact and performance at opposite force. But the approach we chose is that we choose that in Europe and in Africa is that impact is moving in the same direction as performance. At the condition that it's include or it's embedded in the business model of the founders. So the founder has that in the beginning before starting the company. So what we are doing is that we are looking for founders that have impact embedded in their business model. Quick example, if someone go in the village, notice that the people in the village produce hibiscus, and the market, but they are under the potential. He said that, okay, it's unfair for those people, I can help them get the potential, but I also can help get money or performance because I know the market, maybe in Latin America, and we have been seeing successful company like that in Nigeria. So that's how we approach the thing for us. The impact need to be embedded in the business model, and that's why, for example, in our team, when we have the carry interest, our carry interest is aligned with the impact goal that we assign to the team.
Thank you. And Thomas, I'll ask you a founder advice question. If you were to give a founder one piece of advice to future-proof their businesses in these uncertain times, what would that advice be?
I think it's all about the network, actually. I mean, one thing that I've kind of pondered on a lot this year is that the biggest determinant of your lifetime income, and by some measures your lifetime success as well, is not IQ. It's extroversion. And so I think kind of events like this sort of select for that somewhat. And for the founders in the room, you'll probably spend the next couple of days going around getting business cards, making connections, starting conversations that could lead nowhere and could lead somewhere quite spectacular. So I think keep on going, keep on doing it is the main thing. There's a huge number of events that are put up. I mean, I'm quite lucky to be in Nairobi. But there's a huge number of events that are put up around the ecosystem, giving people the chance to meet investors. We do quite a few of those that are sort of sectorally themed in manufacturing Africa itself. But do try and go. Do put yourself about. Do connect with peers who are going through sort of the similar teething problems that you are, and potential investors, friends, allies as well through that process.
Thank you. So I think it's clear from the discussion that Africa SMEs have immense potential, but to unlock this potential, we need the right capital, we need the right partnerships, and we need enabling systems. Growth without resilience is fragile. So we also need to build that. For us to create a vibrant SME ecosystem, we need to bring that together. So thank you to our panelists. Please give them a round of applause. And thank you for joining us in this conversation.